Welcome to the deep dive. When we look at a business, it's so easy to boil its financial health down to just one number, right? That famous bottom line.
Mm-hmm.
But what if that number is, actually misleading? What if an increase in a company's cash actually signals deep, deep trouble? That sounds completely backwards, doesn't it?
It absolutely does. And that's exactly why we're doing this deep dive today. We're looking into one of the most, I think, revealing financial documents, the statement of cash flows.
Okay.
Our mission really is to get past those surface level figures and give you a kind of shortcut to understanding what's really going on with a company's performance and its underlying health. We're pulling the key stuff from our source, analyzing a statement of cashflows.pdf.
All right, let's jump right in then, because there's a big mistake a lot of people make, isn't there?
There is.
You can't just look at the total change in cash and cash equivalents. As you just heard us say, more cash doesn't automatically mean everything's rosy.
Not at all.
In fact, this is where it gets interesting. Imagine a company, maybe it's struggling to bring in cash from its normal business. What does it do?
Well, it might be forced to do something like sell off its buildings, its properties, and then lease them back. Think about that. I mean, it does give them a quick cash boost, sure, but it's a massive red flag. It's a clear sign of distress, not strength.
Right. It's not sustainable.
Exactly. How many properties can you keep selling? Plus, now the company owns less stuff, fewer assets. That makes it harder to get loans in the future, doesn't it? It really limits their options.
I see.
So this example really shows why a good analysis has to dig into the reasons behind the cash movement, not just, look at the final number.
So it's the story behind the number, not just the number itself.
Precisely.
And the statement of cash flows helps us decode that story with three key sections. We've got operating activities, investing activities, and financing activities. Each tells a different part of the tale.
Okay, let's start with operating activities. The first really critical figure here is cash generated from operations.
Right.
This tells you how much actual cash the business is pulling in from its core day-to-day stuff, making and selling its products or services. And crucially, this is before you factor in things like buying big assets or raising money. It's basically the cash profit from just running the business.
So the cash they actually make from doing whatever it is they do.
Exactly.
Now, you mentioned something about quality of profit. How does that fit in?
Good question. You really want to compare this cash generated from operations number with the profit from operations that you see on the profit and loss statement.
Okay.
Ideally, you want those two numbers to be pretty close. The closer they are, the better the quality of that profit. It means the profit isn't just on paper, it's actually turning into cash.
And what if it's not close? What if the profit number looks way bigger than the cash number?
That's definitely a red flag. It suggests the business isn't very good at turning its reported profits into actual spendable cash.
Which could lead to problems paying bills.
Exactly. Short-term liquidity problems. They might struggle to pay suppliers or employees, even if they look profitable on paper.
And often the details are in the working capital movements within that section, right?
Absolutely. The devil's in the details there.
Like if you see big jumps in receivables, that's money owed to the company or in inventories, their stock's just sitting there.
Yeah, that can signal cash flow issues. Maybe they're struggling to collect debts, maybe some debts won't ever be paid back, or maybe they've given really long payment terms to a big customer just to get the sale. Either way, the company still needs cash coming in to pay its own bills, its payables, on time. That balance is crucial.
So what about the other side? What if payables, the money the company owes, shoot up?
Well, if payables increase significantly compared to everything else, it might mean the company is deliberately stretching out payments to its own suppliers.
Holding on to cash longer.
Exactly. It makes their cash position look better at the year end, maybe? But it's a risky game. It can damage supplier relationships, and it's really just delaying the inevitable, kicking the can down the road.
Okay. So ideally then, what should we see in operating activities?
Ideally, cash generated from operations must be positive. That's fundamental. It shows the business can cover its basic running costs from its own activities.
Makes sense.
And even better, that positive cash flow should ideally be enough to cover interest payments on debt and taxes without having to borrow more, issue shares, or sell off essential assets.
Right. If they can do all that from operations.
And whatever's left over, that's what we often call free cash.
Free cash. Okay. And what's the best use for that?
Well, how a company uses its free cash says a lot, ideally. Paying dividends is good. It means they don't need extra financing just to pay shareholders regularly. Or investing in non-current assets, new machinery, property, things that should generate future returns and help the company grow.
Investing in the future.
Yes. Or another great use is paying back loans. That reduces future interest costs and makes the company financially stronger. It shows they're building resilience, not just, getting by.
Okay, so that covers the day-to-day engine of the business. What about the bigger picture, the long-term stuff, investing activities?
Right. This section zooms in on cash flows related to those non-current assets we just mentioned, property, plant, equipment, the long-term stuff.
This is where you see if they're building or maybe shrinking.
Precisely. Now, selling assets isn't automatically bad. If a company sells old equipment to buy new, more efficient stuff, that can be positive, part of growth.
Oh.
But, and this is the critical warning we mentioned earlier, if a company is just selling off assets to patch up short-term cash problems, that's a huge danger sign.
Because it weakens them long-term.
Massively. Fewer assets mean less security for loans, so banks might get nervous. It really suggests the company is shrinking, not growing. It's just not a sustainable way to survive. It's a temporary fix at best.
Yeah, you can't keep selling the furniture to pay the rent, as you said.
Exactly. So a key takeaway here. Asset sales should not be funding daily operations or paying dividends. That's just poor cash management. Full stop.
Got it. Are there any recurring flows in this section?
Sometimes. While buying and selling big assets might be irregular, things like interest received from investments the company holds or dividends received from shares it owns in other companies, those can be regular cash inflows in the investing section.
Okay, so we've seen how cash comes in from operations, how it's invested. What about how it's funded? That brings us to financing activities, right?
Yes, the third piece of the puzzle. This section tells us how increases in assets, or just the business in general, are being paid for. Where's the money coming from?
And what's the best case scenario here?
The absolute best. Financing growth purely from operations. That shows the company is generating loads of surplus cash. That's the dream.
But that's not always possible, especially for big investments.
True. So funding through long-term sources is also perfectly normal and often necessary. Things like taking out loans or issuing new shares. The key is matching the funding type to the asset type long-term assets funded by long-term finance. That's stable.
Okay, let's talk trade-offs. Taking out loans seems simple, but what are the downsides?
Well, the obvious one is higher interest payments in the future. That eats into profits.
Right.
It also increases the company's gearing its debt level. And if gearing gets too high, lenders might see the company as riskier and charge even higher interest rates.
Potential spiral.
It can be. And eventually, lenders might just become reluctant to lend any more money at all if the company's already heavily indebted.
Okay, so what about the alternative? Issuing shares.
Different set of consequences there, the big plus. No interest payments, and it doesn't increase the company's risk profile in the same way debt does.
But there's always a but.
The but is, now you have more shareholders sharing the ownership, which means future profits are spread more thinly, and the total amount paid out in dividends might have to increase down the line to keep all those shareholders happy.
So it dilutes existing shareholders' stakes.
Potentially, yes. And it changes who benefits from future success. So it's a trade-off between debt risk and sharing ownership.
Wow, okay. So putting it all together, analyzing a statement of cash flows is clearly not just about checking if the cash balance went up or down.
Not even close. A really strong analysis pulls together all the information from operating, investing, and financing activities.
Right.
It builds a complete picture, a narrative about the company's performance and its financial health. It goes so much deeper than just that one top line or bottom line number.
So why does this matter so much for you listening?
Because understanding these nuances, these stories behind the numbers, empowers you. It lets you look at any company's financial report with real critical insight.
You can spot things others might miss.
Exactly. Hidden strengths, or maybe more importantly, hidden weaknesses that those simple figures just gloss over. It makes you a much sharper, more informed observer of any business.
Absolutely. So maybe the thing to leave everyone thinking about is this. When you next look at a company's cash flow statement, what does its particular mix, its choices across operating, investing, and financing really tell you about its priorities, about its real strategy, and maybe its vision for sticking around long term?
That's the key question, isn't it? What's the real story?